there's another way to earn $100,000 passive income than investing in property. And I'm ashamed to say it, but I think this asset class is actually going to be more powerful than property. And today I've got a special guest on, who's actually our operations manager, Austin, to talk about this topic, this investment class that I think will leave people shell-shocked. And I think you want to stay to the very end because it's something different, unique. Maybe you've heard about it, of course. I think everyone's heard about it. But maybe you haven't heard about a way of investing in something like this that is actually passive. You sit there on the side, it works for you. And if anything, it'll earn you more money. So, Austin, welcome to the Invest in You podcast.
Thank you very much for having me.
Well, you're welcome. So today we want to talk about other ways of making money. Property is great. You invest in it, it grows, and then it produces a cash flow, which is awesome. That's what we all achieve to have because we want to retire, replace our income. You've gone down a different route. So you went down the traditional route of building wealth through property. And then you said, I'm going to take a U-turn and I'm going to go down a different route. And I'm going to do it in a way where I'm actually not physically in the business.
Yep.
And that was by acquiring businesses that bring in a passive income. You sit on the side, do your 9 to 5, which this is what you do at Fresh Start. You work, you're an operation manager.
Yep.
And you've got a business on the side generating an income.
Yes, correct. Yep.
So let's peel it back. Tell me the backstory of like what made you go down that road and how you got started.
Backstory is I want to control my life, realistically. I want to enjoy time with my family, young kids, young family, wife, and I don't want to be working through to 70 years old, which is the average in Australia, and then enjoying, let's call it 10 years until you pass away or thereabouts, which doesn't seem right to me. I want to essentially enjoy the better part of the year. I want the life. I want to enjoy 50 years and work for 20, if that makes sense. So that's essentially where it kind of all came from, and from that built out the plan underneath it and put it into motion.
So what made you change from property going into businesses?
Property is great. Property has so many benefits. As we all know, it's probably the most tried and true tested method within Australia of growing someone's wealth. But for me, I like to control how my wealth is grown as well. But I also like cash flow. If you have equity, it's great, but it's unusable unless you tap into it to then withdraw it out and then put it to work, in which case you can continue to grow your wealth from there. But every time you do that, it still limits your lifestyle, limits other factors. So I wanted to have the cash flow aspect. And then from that, I can control how my life operates. I can continue to invest it back into the business, which is scale to create more cash flow, or reduce my time in the business, or I can put it back into property so then I'll have the cash flow and also the equity growing, and both work hand in hand and both can feed each other self-sustainably as well.
So you're saying that you still get that equity in the business similar to what you would in property?
It's different. The way I see it is, yes, it is equity, but it's usable equity. It's cash flow. So it doesn't hinder you in any sense like that. It's not equity where it's just not taxed. It's kind of just sitting within a property. They're two different measures, but I have a business creates cash flow. I can use that cash flow to do what I want, whether it's going on holiday or whether it's funneling it back into property, how you would normally use the equity within your property. But I get to control how that looks and what do I do with it as well. There's no limitations to what I do, or it's just leave it in the bank if I really wanted to and store it for a larger investment or a larger business I want to acquire, depending on the situation.
Yeah, okay. It's quite funny. You're probably going to get listeners or viewers watching this going, Frank, you've got a buyer's agent business. You're telling people to invest in property, and now you've got someone on saying buy businesses. Oh, no, I'm not saying that, okay? I will say, but businesses make more money than any other investment out there.
100%.
That's why business owners will generate more income through their business, and they'll park their money into different assets, and that's what I do. I park it into real estate. You decide to go down the real estate path, but then you've done a 180 and said, I'm going to go and buy a self-sufficient business and let my money sitting there and generate income.
Yep.
Which is a great way as well.
Yep.
There's no right or wrong.
Correct. And I did the property first to grow my grow my wealth. Essentially buying businesses, it takes cash, a significant amount of cash as well. You can get financing, but it's not the same financing that you get through buying property where you can get in with a 5%, 10% deposit. So it was, how can I make my savings work harder for me? I'll buy property. I'll leverage that, build equity, and then from that, I can roll it into my businesses that then create cash flow to then, once again, flip it back into property when I have enough cash flow. Keep on building cash flow when I'm at a happy point and say, I'm pretty happy with where it is at the moment. I can then start feeding it back into the property market as well. And then I'll have the cash flow, the lifestyle, but also have the equity and the true wealth, which is the property side of it as well.
Yeah. So you had to start with property to get into the businesses. You couldn't do it the other way around. Just go buy a business from day one.
You definitely can do it. I didn't go down that route. I went down the property route to begin with, just because it created that safety net for myself and my family as well. It also comes down to where you live. The areas where I lived, the business that I own doesn't really operate out in the areas where I've lived. I've traveled around a bit. So that is a limiting factor. It depends on the industry. It depends on what you're trying to achieve as well. But we were able to achieve what we wanted to, and then circumstances changed. We moved, and then we were able to fast track our plan as well.
Okay. So that's shortened that horizon of when you get to that goal of X amount of income in X amount of time.
Yeah, 100%. It was it was always kind of a 10-year plan. Have properties, expand the property portfolio, sit on and let the equity grow. And then realistically, circumstances with work, my wife's work, that just, wanted to make it better realistically and not be limited by that capacity. So it's, how do we do it faster? How do we hit that 10-year goal? Cool. Let's just bring it forward. Let's just bring it forward by 5 years, and let's just go straight into it right now. And we did it. Obviously, there's a risk in any business. It's much higher risk than owning investment properties. But by doing that, we were able to hit our 10-year goal by year 5. We're able to hit our 15-year goal by almost year 6, realistically, which is ridiculous. And then from that, we can continue to scale at pace as well.
Yeah. Okay. So you've gone there much faster now at a different rate because of the businesses that you acquired. For someone to just go and do this, of course, it can be quite difficult, and people go, "Oh, that's a bit overwhelming." Yeah, you're telling us now to go buy businesses. I'm not saying to go buy businesses, but I think it's another option that down the track you can look at acquiring a business. How did you go down that path of understanding what you're looking at, how to analyze a business, what was involved, how to actually transact on a business, where to look, all those intrinsics? I guess, can you peel it back at the very beginning, kind of like the formula or step-by-step process that you did to learn how to get to where you are today?
It's a long process. I wouldn't suggest to anyone just to jump in straight away and just like, I'm going to buy this business. There was, for myself, it was a year's worth of research. It wasn't, I'm not focused on, hey, I wanted to buy this particular business. The business that I own, the viewers, is vending machines. So I own vending machines. It's to me, one of the most scalable business models in the world, but also one of the most simplest to run as well. And it's very consistent. So it wasn't something I originally thought of. It was, I don't care how I make money. I don't care what the business is. It is just, I want to be in business, and then how do I get into that? So it was the market research. What industries are out there? What does each industry look like? What are the risks? What are the variables? So I was chatting to, on a weekly basis, I was chatting to different brokers from different industries, whether it was restaurants and cafes through to, real estate and other things. How do we assess
so what's
risk
a
from that?
broker? Just sorry to cut you off there. So for people who might be listening, go, like, well, what do you mean a broker of real estate, restaurants and stuff? What do you mean by that?
A business broker. So essentially, a real estate agent sells real estate or sells property on behalf of a seller. A business broker sells a business on behalf of someone who owns a business, and that's all it is. So I was just chatting to people every single week in, week out, inquiring on different businesses, having a look at their P&Ls, understanding, and then after you have a look at a significant amount, you understand the trends. Different industries have different trends. They have different multiplication methods of how they actually value a business. So you understand all the intrinsics from that, and then you figure out, I don't want to have a piece of that whatsoever, or that's interesting. Let's look into it a bit further. Went and met with a fair few different owners. And it wasn't to screw their time. It was, or our time. It's something we're genuinely interested in. Are we going to take this step? And there's a fair few that we almost went into, we almost purchased, but there was just certain things that just didn't line up for us. And then, we essentially kept on searching, then went into different industries. And then one day it was vending machine came up. I'm like, wow, imagine that. Like that's who owns vending machines? And then you realize there's a massive world in Australia of vending machines, people out there with hundreds and thousands of vending machines. Coca-Cola being one of the biggest vending machine supplier in the whole of Australia. And they make a ridiculous amount of money. Then there's other people who aren't Coke and people like myself, and they make a ridiculous amount of money off it. So does it check out? What's the intrinsics? Is it something that's achievable? And then from that, step by step, work through it.
So you got resourceful at the beginning. So you're like, okay, I don't understand what businesses are great profits or great returns and what are selling for a multiple of, because they're higher value. So people listening, a multiple is, if you sell a business, there is a multiple depending on how that business is run. If it's less managed or less owners are running that business, of course it's got a higher multiple, meaning you can sell for more money because it's not relying on the business owner, which is fantastic. But of course, different industries will have a higher multiple. So you've gone to a broker to find out what that looks like, and then what business are selling for. I guess you could say like hotcakes on the market.
Yep.
And then you've got this information from all these brokers, done an analysis before just looking at one particular business like vending machine. Is that correct?
Yeah, correct. Yep. It was just looking at hundreds and literally just P&L would come in, look at it, assess it. The broker might have multiple different listings, so I'd have a chat to him about multiple different ones to just really understand what's out there, and then iron out what I'm looking for and how safe I can create it, because that's one of the big things. Risk mitigation. Property, it's almost risk mitigation within itself. There's so much demand out there. Everyone needs a house to live in. Business, it's not as much like that. So how can we make the investment, make the cash flow, but also mitigate that risk so we can maximize the upside, but minimize the downside where possible?
So when you're getting from a broker, is it easy to say, hey, what do you have on your books? They might say, I've got these 10 businesses I'm selling, hypothetically. Can you just then say, listen, I'm interested. Can you give me the P&L and the information? Is that pretty straightforward? Like it's easy. You don't, even if you're not interested, they'll give it to you. There's nothing like you have to put down a deposit or anything like that. Nothing like that.
Yeah, no, nothing like that. It's no different to looking on realestate.com or domain, where you make an inquiry and they send through the rental appraisal and some other basic stuff about a property. It's no different. There's there's websites out there that you can just inquire on this particular business here, and that inquiry will send through some basic sort of information. Part of it potentially being a P&L. Sometimes there's some other stuff factored in, or it's just a bit of a rundown of the business itself and the owner situation potentially. And from that, you can ask more questions. You can go into more depth, or you can just say, no, I got enough. That's enough for me. I don't need to take a step further.
So step one, you kind of done your research, understanding businesses from different, brokers, and understanding what's good, what's not, what's selling higher multiple. Yep. You go to step two, you can start grabbing financials from these brokers and other pieces of information, assessing it. I'm assuming you go to your accountant, you sit down, you look at it. Is it making money? Is it not making money? How much money, etc.
Yep.
And then from that next step, what do you go? Is it even further due diligence, and kind of how do you work around that?
Yeah, the first step is always having a look at the financials. You need to, if you don't understand how to read a P&L, bad statements, those sorts of things before doing this, I'd say that's even probably the first step. If you want to step into business, you have to have a solid understanding of how to understand financials of a business. So then when they come through, you understand what you're looking for, the discrepancies that come from it. Every time you go to an accountant, they charge, which is 100% fair. So I would, if we were 100% happy, like we'd got the financials, I'd ask a million questions based on, depending on the industry, what those questions might be. And then we say, yep, we are happy. From that, then we'd essentially make an offer negotiate, get it locked under contract, make your deposit, and then from that you can request even more financially. And then that's where I bring my accountant in. That way I save a cost going to the accountant, but I also have a solid understanding of whether it's worthwhile beforehand as well.
How can you trust the financials, but how can you just, they're just not, mocked them up and said, hey, we'll make a profit and we're going to sell it?
It's a great question. For the most part, there's discrepancies that you can look for. When you cross correlate the P&L over to the BAS statements, so realistically, P&L being post GST being taken out, let's say it makes $1 million in revenue a year, then from that you can cross it over to the BAS statements and you're like, yep, okay, cool, I can see it here and it roughly matches up with the P&L. That's a very good sign. You know that it's making the money that it says it's making. That's not stuff that you can really falsify unless it's a drug dealer and they're throwing cash through the business. That's a different story. In which case, it's hard to work around that one. I haven't come across that yet, so stay tuned for that when I figure that one out.
If anyone has, again, just more than welcome to share your story on here.
Yeah, please do. But that's the first step. There's a Pizza Hut I was looking at going back, would have been 12 to 18 months ago, and the biggest issue that you find when is it making money that it says it's making is when that business owner owns two businesses and they run it under the same ABN. That's understand why they do it, but it's also a concern because you can have multiple different incomes coming in and that person can say, hey, this business is making this much money, but it doesn't mean that there is. It could be this one's making 80% of the revenue and this is making 20%. They're saying that, hey, it's making X amount, but they're just paying some bills and stuff from this one to bring down the bills on this one to make it look like the net profit's higher on the option A. So that's a concern and something to weed out a bit further. There was a Pizza Hut a couple of years ago that we were looking at and we were very heavily interested in. Pizza Hut's there. Notorious, it's franchise. They make money. They have a brand name. There's a lot of recognition behind it. And it had all the staff in place. It was solid, but the owner owned two of them. They were still kind of working about 15 hours a week in one and 15 hours a week in the other. So not massive hours. But from that, the issue I came to was there's a fair few delivery costs coming through Uber Eats and Deliveroo and all those other ones. It was hard to quantify because they had all the delivery charges charged in together. And they were saying, oh yeah, it's X amount is through this one. It's not through that one at all. But it was hard to get 100% justification from that. And the risk with it is, let's say this business is making $200,000. The delivery charge is coming in $100,000. You're going to spend $400,000 on this business. Is it going to be worth the risk if you're going to lose $100,000 straight out the gate? Potentially, if you can't, because they couldn't provide the statements to actually show this one here is specifically for this business. So that's where essentially I walked away because I couldn't justify, I couldn't get 100% accuracy or at least 99% accuracy. It was just that, red flag.
So clean. They didn't have clean financials.
Yeah,
basically.
Yeah, and that's always the first step. If doesn't have clean financials, hey, like it's a normal thing in Australia. Business owners paying people some people through the books, paying some people through cash and stuff. Very notorious for restaurants and cafes and those sorts of things. And they'll be like, it's making $200,000, but then you factor in all, we're paying $150,000 through cash every year to our employees. Like, I want to run a clean business. As soon as you start doing that, there's more super, there's more of everything that kind of gets tagged along, in which case then it lowers your net profit at the end of the day. So there's always those things that you look out for, and it's whether you want to take that step or whether you don't, whether you want to take the risk or you don't. For us, we want clean financials first and foremost, and then from that we can work on the scaling model once we actually have the business.
Okay. When you're looking at all these businesses, was there a correlation of certain businesses that were great businesses that had a higher profit margin or, I guess a higher multiple than others?
Yeah, there's I guess a lower multiple would be the way to put it. So a business making $200,000 net profit, let's say it's under management, then that will say a restaurant, they might sell that for kind of 400K, give or take, depending on the area, depending on if it is under management or if it's not. As soon as you kind of go into your tech industries and your IT industries and those sorts of things, the multiple actually becomes higher. They're making X amount, the business will be valued significantly higher. You can put that down to any tech business out there. You've got your Amazons, your Facebooks and everything. Their multiple is ridiculously high in comparison to your stock standard general Australian businesses as well.
Multiple. So your multiple goes off not the revenue, off the profit, net profit.
Yeah, correct. For the most part, yeah.
For the most part. So you got to show 100 grand, 200 grand, whatever it is, and then whatever that industry, whatever the business is, and what sector. Of course, there's a multiple of 1 to whatever it may be, 10 plus.
Yep. And then a big factor behind that is if it's under management or what's the involvement of the owner. Are they 100% running it? They're 40 hours a week. Realistically, no owner's 40 hours a week in a business. They're 60. But let's say, are they full-time or are they, is it under management, in which case they're doing pretty minimal. So under management is that term. It is literally has its managers in place. So if it's under management, the multiple will be higher. So if a business is making $100,000 net profit under management, it might have a multiple of 3 to 5. So therefore it'd be valued at 300 to 500. Depending on the industry, it might even be more if it's a tech industry or something like that. If it's owner operated, then you're making 100 grand. Realistically, it'll be sold at like 100 grand, maybe more, maybe 100 to 200, but it's only a 1 to 2 multiple for the most part. Certain industries might stretch a little bit more, but the multiple is lower if it's owner operated.
Owner operated, yep. So you want to get out of there as much as the business owner you are, love the business, you want to get out of there, put it under management, higher multiple, higher profit.
Yeah, and that's it. Some people go into business to sell the business, and if you can have a business and scale it and then have the manager in place and it still runs consistently, you can sell that for a mozza. But if you're still in it, some people just get over being business owners or they've just done it for so long. But as soon as you have that manager in place, there's so many benefits. One, you can sell it for a higher multiple, but the second thing is you can actually just focus on the expansion of it. It's no different to fresh start or whatever, but the day-to-day operating is completed, so then you can focus on the relationships and the business development so that you can actually scale the business, take it from here to the next letter and keep on going up. Yeah. If you're 100% focused inside the business, it's hard to do that because your time's consumed.
Yeah, that's right. So you've gone and you've looked at this vending machine business. Do you want to walk us through what that process was like? How many vending machines were there when you've purchased it, and how much you got now?
Yep.
So I guess start from the beginning.
When we first started looking, vending machines is a funny one. So when I say vending machines, we own vending machines across different parts of southeast corner of Queensland. So North Brisbane, Brisbane City, Ipswich, Boonah, South Brisbane as well. And then at the moment, we're currently expanding down to Gold Coast as well, and then essentially filling in the gaps in between. So it's hard to get finance on vending machines. It's essentially, hence why I went into property to begin with, so that I had something to leverage off. I could withdraw equity out to then use that as my finance. So it makes it easier and simple. From that, and that's exactly what we did. We used equity we withdrew about $300,000 worth of equity from one of our properties. We folded that or withdrew it all, and then we went and started looking at businesses. There was a vending business that came up. It was a lot higher. It was, at the time, it was $900,000, give or take, worth of value. We couldn't get finance on it. I had the $300K, so we purchased a portion of it. Vending machines is it's excellent in that perspective, because you could literally break up a $10 million business into chunks, and you can sell them off at $100,000 chunks. You can sell off one vending machine. You can sell it off into $2 million chunks. You can do whatever you want. And the same thing goes for buyers as well. You can buy whatever and scale at whatever pace you want, depending on your cash flow. So that's where we started. Couldn't get the whole chunk, unfortunately. It had staff in place. It had the operating procedures in place. So that's what we were hoping for. Couldn't do it, unfortunately. So we bought a chunk of their business. We bought about a third of their business. And then from that, started from there. We ran it for a bit. My wife stepped in. She did the day-to-day filling. We were both out there, 2-3 nights a week, picking boxes, all the chips, chocolates, drinks, everything to go into the boxes. So then they get taken out to the vending machines and filled. And then from that, once we had the process down pat and everything was running fine, and we saw the money coming in and everything was great, then the next stage of the process was we're getting an employee in. We knew that for us, it was just about, it's all just a numbers game. We knew that we had to buy a certain amount of revenue for the numbers to make sense to put an employee on. So within it would have been 2 months of owning it, we had an employee in place. And then our time got reduced. He's out there filling it, takes probably 13, 14 hours a week away from what my wife was doing. And then all we were doing was just filling. And that was, picking boxes. I think it was like back then, probably 3 hours a week. Like it's pretty minimal. And then I was doing stock take on a weekend. So it's another 2 hours total. So very minimal, very great return from it. And then from that, just scale. We weren't in the business. We were just focusing on all the cash that's coming in, fold it back through. And we started out with 23 machines, which worked out to be, at that point in time, about 250K worth of rev, which we expanded up to about 300, made some improvements to the business. We brought up to about 300K worth of revenue straight out the gate, which is awesome. And from that, it's just, you've got your net profit, fold that back in. And from that, that's 2 years ago, just over 2 years ago. And now we're doing over $20,000 a week. We've got 65 machines, looking at another run this week, where it'll add another 400K onto our top line as well. So we'll take it to, realistically, in the next 12 months, we'll be at 100 machines. So essentially we've probably 5x, 6x, 7x our business within a 2.5 year period, just because we've got 2 drivers, we've got a picker, all staff, and we can just focus on the development, the connections, and building relationships to find the sites and everything, so we can just keep on scaling at pace.
So where do you store your stock? You stock it in your house now, or so because there's a bit more logistics involved. Yep. It's not like, hey, we've just got this stock, we just pick it up from someone's house.
Yep.
You got to store these things, and there's a bit of work involved.
Yep.
How's that all work?
A standard garage will do. A double bay garage is completely fine, especially when you're starting at that lower level where we were. We rented a house specific, like we don't care where we live. It was more so about how do we logistically make it work. So there was a house with a shed, and that's the one. And we were able to run a business. We're still running it at that point. We're running $1 million business out of a shed in a garage. We're moving to a warehouse in, give or take, 2 weeks' time, just because we're at that point where it's just not sustainable to keep in there. But also, the business can also sustain it. It's there's rent to pay, normal business. We've grown that much, it makes sense. But the business can operate completely. We went over to Italy this year, and the business ran fine without us while we were overseas, which was great, right? And that's everyone's dream. So we can continue to scale. But yeah, you need a warehouse, you need a van to start out with, depending on how big you are. Some people can get away with a car, you just lay all the seats down and everything, but we just went out and bought a van, so we could just know that we could do it straight out the gate. The risk was somewhat low as well, like a van, you can sell it if things went pear-shaped, so it wasn't really a concern for us. But yeah, that's where we kind of took it to, and now we go into a warehouse because we're just outgrowing the space.
So what will the multiple be on a business like that? When you've got it self-sufficient, you're not really doing much. You're doing this more the accounts now and bookkeeping and stuff. Like, what's if you got to sell that thing? Let's say you get it to, you got a 1 million rev now or more. You say you get it to, I don't know, 2 million rev, and you're making whatever you're making, your profit you're making. What's a multiple or something like that?
Vending machines runs in a different capacity. The multiple would probably work out to be, I don't know, four times multiple, give or take, in like our capacity where it's under management. The easy way, if you look on vending machine businesses, online, you literally just type it in and they come up in your area. It is literally whatever the revenue is. So it's kind of like, it just makes it simple, because for how vending machine operators think and operate. If it's doing $1 million, realistically, you could sell it for all everything, probably 1.2, give or take.
Okay. And so what's a healthy profit margin that a business like that should, someone that's looking for a business like that should be aiming for?
20% and above if you're not inside it. If you're inside it, obviously you've got less wages and everything. Potentially you might do more work than your standard employee who might do 8 hours a day. So you can potentially fit in a few more things. But yeah, for us, we're sitting between 20% to 30%. Say 25 as an easy number. So the multiple being roughly 4. But as you get bigger as well and expand further, you have less fixed costs, so you can make the team that you have work harder, not in a negative sense, but because your portfolio of machines becomes larger, you can make the process more efficient, because it's not just like, hey, they've got to go there. There's clusters being built and around, so it actually makes the driving time smaller, so they can fit more in their day, so the net profit actually becomes larger the bigger you become. There's people out there, like I said, who have 1,000, 2,000 machines, and their net profit is great, sitting at 30% and above for an, call it, undermanaged business, which is hard to find. It's almost impossible to find.
I think people might listen and go 20, 30%. What's that mean? That's the money, or that's the percentage of profit you're making off the revenue.
Yeah,
which is huge.
Yeah.
I remember my first ever business coach. He goes, if you're in that space of a business of 0 to 5%. It's kind of like a business that most businesses might be like that. It was when you start to go from 5 to 10%, you're in a pretty good environment, you're pretty healthy, you're above average. Then when you start to go 15% or above, you're well above normal percentages of what profit you're making from percentage, which is quite astonishing. But I think, having a 20, 30% profit margin on a business that you're not working in, and you got a full-time job, you're working at a Fresh Start, and your wife is basically now, she's taken time off work, like reduced her hours?
Yeah, she does 3 days a week at school. She's a school teacher, so she does 3 days a week at the moment. She's the backup driver as well, so driver's sick, she'll jump in, she'll fill in. One of our pickers is sick, then we'll jump in and we'll do that at the night time after the kids go to bed. But yeah, like realistically, as we expand a bit further, she'll drop back a further day. So she'll drop back to 2 days a week and just make sure everything's running, but also get to make sure that our life is still all together. We can obviously afford to as well, because making more and more money, then one less day of work is still sustainable and achievable. So that's essentially that next step for us, which ideally will happen probably in the next, give or take, 3 months, all going well. And she can have 2 days a week, make sure the business, if anyone's off sick, handle it all. Also make sure that our kids are fine as well.
Awesome. So what's the goal? What's the end goal? What's the goal for Mr. Austin?
End goal. I don't know if there is an end goal for anyone who's overly ambitious. I think it's just there's another goal. I guess for me, the whole goal, the first initial goal was 100K, and then we've achieved that. Then it's 200. We've achieved that. Where do we go to here? It'd essentially be 500K worth of net profit. But then from that, it's how do we want to then start creating the life we want. We're doing, between us, I don't know, 120 hours a week sort of thing, or 110 hours a week. We want to enjoy our time with the kids, and kind of have that flexibility. So still work, we'll still always have our projects and our businesses and our investments and working at Fresh Start and everything, but we want to have the ability to control our life a bit more, have the business operate, but not be limited by, everyone wants to go to a beach on a Tuesday or whatever. Like, I'm in Queensland, beach is beautiful. Not like, hey, we're going to go down on the weekend because we're doing stuff during the week. We want to be like, hey, it's a Tuesday, or we're just going to go to the beach or whatever. You can still do all your work, doesn't limit that, but you can also just have that freedom and flexibility, also live in the places that you want. And on top of that, ideally for us, homeschool the kids, 5 years time, give or take the kids out of school and, have them included in the business, teach them those what I'd call really important lessons in life and how to read P&Ls and BAS statements and all of those things that nobody ever teaches you, and the financial literacy behind actually getting ahead. But then on top of that, being able to enjoy that time. You can then school down to a 3-hour day realistically and teach them some actual useful stuff for another couple of hours, and then also enjoy the time and let them be kids and spend the time with them as well.
Off topic, were your parents like that and that's where you got your traits from?
My parents, they run a business. They're dairy farmers. So it's, I don't know, dairy farmers, they have a business, but you're tied to the farm. So there's traits from it, definitely, which is hunker down, work, save, invest for the rainy day, because everyone in Australia knows that you've got droughts and you've got floods and you've got whatever disease that comes across. Like there's so many different things, and there's a lot of things you have to plan for. But we've taken it to the next step, which is we want to not be tied down. We want to have the freedom and flexibility, have the income that a business owner has, like my parents, have the lifestyle. They have a great lifestyle as well. Even though they're tied to the farm, they have a great lifestyle because they enjoy the place. Yeah, it's a farm. Like you get to do what you want and kind of control your day-to-day however you want. But we also don't want to be tied down to it. We want to leave essentially the farm. We can go over to Fiji for a week on a whim. We can go to wherever, not during Christmas season because everyone's shut down at Christmas and your workplace shuts down. We want to go to there during a normal, a school day or school term, I guess, if that makes sense. So you can kind of just enjoy life on your own terms.
Yeah, awesome. I love it. I've spoken a lot. I wanted to speak on one last thing because it's not always, rosy. It's not always the rose. What's the saying they say? It's not always.
Roses aren't always red or something
like that.
Yeah,
roses aren't always red. It's not like you're just going to walk through, find a business, walk in, it's going to be fine.
Yep.
There is negatives.
100%.
There is negatives. And I think you've gone through negatives as well.
Yeah.
And I think it might be good to share because I know your story. I know you very personally well. You've bought businesses that have done well. You've bought businesses that have also gone the other way around, and that's been quite difficult. And I think there's a lot of learnings, probably more in that than what the successes are.
100%. If you don't learn from I won't call it my saying is it's if you learn from it, it's not a mistake. It's just something that happened, right? So we purchased a business on paper, on financials, on all accounts, everything was great. There was nothing that was unturned. And then from that, we went into it, everything was great. And then things came apart. How do we fix it? We slowly built it back up, but realized it's not what we want. We took a hit from it. And that's probably one of the biggest lessons for us was it actually puts it into perspective of we essentially sold it. We made a loss, but it also let us be able to recoup and focus on other avenues, essentially the other businesses that's making money as well. But yeah, it's not all sunshines and daisies. As any business owner would know, there's your good days and there's your bad days. There is heavier risk when it comes to owning businesses. You can try as much as you can to mitigate it, but you also always have to have that backup plan in mind. Ours, we had the properties as security. We had the ability to say, you know what, if anything went wrong, and we also had the cash flow from our current business as well. Obviously, not everyone has that ability, but we created the interim lifestyle or the interim ability to say we're well protected either way. We're very insulated. If this goes well, it'll go very well, and we'll go from, we would have hit our, I would say, the 25-year goal within probably 7 years. Didn't work. So the potential or the risk to reward, risk was low. It was a couple $100,000, which we could hold and we could sustain, but the reward was up here. And there was franchise models. There's opportunities to scale, which is a big thing. So we took the risk, didn't work in our favor. We built it back up to a sustainable level. We sold it. Someone's running it well right now. It's not an operator who's running it. But from that, we've also been able to focus our attention into other avenues, which then, so essentially it hasn't stopped us. So I guess that's what I'm trying to get at. Like don't think it didn't go well. It just doesn't work. We've made massive wins. We've had losses. We've also making more and more wins again. So it's just about how do you minimize the downside but maximize the upside. Something does go wrong. How do you protect it?
What was some of the things you can share that you learnt, if it was the financials, if it was the management, that you can say, okay, this is a tangible thing. This is what you got to look out for, or this is what I went through, because you went through that loss, and I know it was pretty big hit for you guys. But of course, like you said, there's a lot of learning. So what for the people listening and they're going, okay, we want to look into something like this. What do I have to be aware of to make sure this doesn't happen to me?
Yeah, something like that happens. It refocuses our attention to obviously what we want in life, but more so to the point, what sort of business do we want? We realize that everyone's going to have their own perspective on it, but we realized the sort of business that we want was something that it could be faceless. As an example, vending machine business, it is 100% faceless. The people the businesses that we service, they don't even know that we, like, who I am really. I speak to them on the phone, but they've got my guys just going into it if another driver comes in because that driver's away. Like, it doesn't change anything. The business that we had, which failed, what
was that business?
It's a hairdressing business. It was run under management for the most part. Owner was doing, call it 10 hours a week as a fill-in, but that was about it. And it was making great profit. Like the multiple on that was outstanding. So there was a massive upside to a there's a downside. We were comfortable with it, I guess. But a big thing was something we didn't take into account was the face of each individual person inside that business, how much the customers get tied to them. As an example, Fresh Start Advisory wouldn't be Fresh Start Advisory without yourself and yourself and Adrian, right? You guys are the face of the business. Similar to that business, that hairdressing business, there was people are the face. Someone leaves, they take a good portion of that business with them, which is unfortunate. Something we just didn't account for. We did a fair bit of DD on it, and the risks were managed. Essentially, it was like, yep, there's no concern. Based on all of the questions, all the DD that we ran through, meeting these people before we even, essentially kind of settled or anything like that. So during the DD phase, we had all that kind of in place. Circumstances change. It is what it is. But that was a big thing for us, which then just goes to how do we make a business how do we build a portfolio of businesses that's faceless? That way, if an employee leaves, it doesn't actually affect the business. It might affect the slight operating because they were a great employee, but you can hire someone to be a great employee, but someone who is the face of the business, that takes a big chunk. So other businesses we're interested in, obviously vending, scaling that, but like supermarkets and things, they're necessities, but they're also faceless. You can hire more staff, you can train more staff, they're interchangeable, whether it's a 17-year-old or if it's a 27 or a 57-year-old. You can interchange people in and out, minimize your risk, but it's also a necessity, and they're just 100% faceless.
So have a business, let the business run. You're not running the business you're not the face of the business. Yep. There's management in place, and you're just collecting the cash like any other investment.
Yep.
But just it's kind of similar to property, but they don't know you're the owner.
Yep.
It just makes you whatever it makes you.
Yeah, exactly. That's literally the whole idea, so that we can then focus on bigger and better things and continue to scale over time and create the life that we want as well.
Sounds like a fairy tale.
Every business owner knows there's definitely no fairy tale in business, but the larger the business becomes, those smaller, those concerns that start out as like, geez, that's an issue. The more money you make, the larger the business grows. That concern becomes minimal. You've got at the start, you've got a $3,000 issue. Like, geez, that's a fair bit of the profit. There goes, like 3 weeks worth of profit or whatever. As the business grows, it's like, it's fine. Like it doesn't matter. you'll continue to prosper as well. So yeah, definitely no fairy tale, but if you continue to learn, you continue to grow, and you can continue to scale and not kind of be deterred, then I think it's just what you make it, right? Like you're going to have the down days, but if you keep on having good days as well, and you turn the down day or learn from the down days, then you'll continue to prosper, and you'll get everywhere you want. You want to make this, you want to be this, you will be that.
100% agree. I love it. That's awesome. I think this podcast just shows that sometimes there's more than one way to do anything. And I'm not the type of guy where I'm a business owner. I run a business, it's a buyer's agency. We help people invest in property. And people that are listening, watching this, there is more than one way to skin a cat. I'm not going to be like those other guys out there that are online going, this is the only strategy, this is the only way it works. There is multiple ways of how things work. And I think property is an amazing investment. I'll always keep investing in property. I'm buying a couple right now. But businesses sometimes are probably a better investment or a higher return on investment. Of course, a little bit more work, a bit more risk. You need a bit more of a different skill. It's a little bit harder. But you can learn. You can learn. There's people, I know there's courses, all these things out there that you can learn. But even, just understanding how a business operates, and if you've got that skill, or if not, you can learn that skill. It's very you can transfer that skill into any other thing as well when it comes to understanding how business works. So I think we can debunk that, property is not always the number one asset. I think there's businesses that make more money than property. And that's 100%. Fair to say, and I'll agree with that. Because my business makes me more money than what my properties do. And even if my properties were all paid off, I'll still make more money in my business.
Yeah, 100%. And you can scale a business, depending on the industry, you can scale a business to an easier degree as well, which then obviously improves your ROI. So then it becomes a self-sustaining method, similar to property, but as then you have to have the equity, but then potentially the negative cash flow, you have to be able to sustain that. Your business is making money, you fold that money back through. It's just an ever-evolving, like a snowball effect, and then you just have this massive snowball essentially at the end of it, which is great, right?
100%. And then you got this thing just running there doing its thing.
Yep.
Takes time. It's not easy. It's not, just a walk in the park. It's something that takes a lot of time, energy. Austin's taken, years of learning this.
Yep.
And of course he had a lot of, he's had a lot of wins, but of course you had that big failure that set you in April back, and now you guys have learned from that, and it didn't stop you, and he's kept moving forward. So hopefully you got value from this. If you did, like this podcast, because it means we're seeing who's listening to these type of episodes. And if you're getting value as well from this, please share your thoughts or your comments, because we actually read the comments. And if there's any other recommendations of type of guests or topics that you guys want, just reach out. So Austin, thank you again. It's been an awesome episode.
And if you've got any questions about vending machines or other businesses, shoot them through.
Yep, definitely.